Hello, everyone, and welcome to this crossover podcast where we're merging the weekly watch and our Bondcast podcasts into one for just this week. So this week, I'm joined by Giles Gale, our head of European rate strategy, and Jan Nevruzi, our U.S. rate strategist. We're going to be focusing on rates markets. It's been quite a week as markets have shifted focus to some degree, though not completely, from concerns about inflation and central banks needing to tighten, in many cases aggressively so, to the other side of the stagflation coin and worrying about the growth impact of both the cost shock on consumers and the growth implications of tighter policy, often reflected through weaker risk assets. Listeners know this is a theme we've been expecting to emerge for several weeks now. And while at this point we still shouldn't be surprised by the speed and veracity markets adjust to things, but recent moves still have been pretty much astonishing, especially again, as I mentioned, risk assets. But even so, by many measures, valuations in stocks and other assets are objectively only back to fair and not yet cheap. So our expectations are for more volatility to risk to continue as we go through this process, and these moves are potentially not over. So caution's warranted. But as this is not just a weekly watch, but a Bondcast, I'm going to quickly turn to our guests to talk about how this volatility all fits into our fixed income outlook. Obviously, a key component, not just for rates themselves, but also performance in credit markets and rising yields has been one of the contributors to equity volatility in addition to FX volatility. So let's start with Jan in the US. John, have rates peaked? Why have Treasury yields fallen lately?
I think it goes really back to what you talked about, risk assets taking the hit. And this last leg feels like it was driven a lot by weak earnings. And the details in those earnings pretty much talked about things like inability of retailers to pass on costs, or maybe not inability, maybe lack of desire, but just inflation eating into profits as opposed to actually increasing them in nominal values, or buildup of inventories that they still haven't been able to get rid of. Still a lot of chaos going with their supply chains. And you would think industries like that would be well positioned to weather the storm. And if they're not, then the question comes to mind, who is? Which drove yesterday's 5% sell-off in NASDAQ, and we kind of continue seeing a weakness in equities. But then alongside with that, as you would expect, bonds are also outperforming, and 10-year yields have now fallen well below their local peak at 3.2%, now hovering around 2.8. So I think it is probably too early to say for the longer term if yields have peaked, but for now we still maintain this view that peak hawkishness has indeed been reached. And as people start worrying about the growth impacts of both inflation and the Federal Reserve's actions, we kind of see the curves flattening and kind of longer part of the yield curve outperforming.
So speaking of the Fed, have we learned anything from Powell or the Fed lately? They continue to be quite frequent speakers on the airwaves.
Yeah, I think the message is clear that over the next two meetings, we continue getting 50 basis points at each meeting. So the June 1, July 1. I think going into the June meeting, it will be interesting to see how the next inflation report plays out as it comes during a blackout period when there's not going to be any, kind of like cushioning to be made by the local presidents, or kind of preparation in advance of the meeting. So what we learned was we are getting 50 basis points next two meetings unless something drastically tips over or inflation drastically accelerates. That is in line with our view, and we expect a return to, call it normalcy after that, back to 25. And in our view, the Fed is more likely to go back to 25 than push it up 75, given the kind of like the sell-off in risk assets and how financial conditions generally have tightened. They don't really want to overdo it in a sense that it becomes counterproductive. So the message was the plan is 50-50. We're going to do whatever it takes for might go above neutral, but for now, we're sticking to our plan and don't try to kind of overinterpolate.
Okay. All right. Switching to Europe and the UK, Giles, you get to double dip this week with Imogen not able to join us. So let's start with the UK. Bank of England's been quite pessimistic about the economic outlook, but you have had some pretty strong labor market data this week, including on the earnings side. So markets seem to be saying that they're still going to take a bit more of an effort, at least, than perhaps the Bank of England's even signaling at the moment in order to get inflation in check. So what are your thoughts there?
Yeah, well, first of all, I know it's a big disappointment for regular listeners not to have Imogen on for this week, but she'll be back, don't worry. So yeah, we did have very strong labour market data this week, and I mean, it certainly was a lot stronger than we had in mind. I mean, the details were, unemployment were down, employment was up very, very strongly. There was inevitably, I suppose, a focus on real wages having taken a hit. That was, I think, given how high inflation is, really nailed on. No real surprise. The surprise of anything actually was that it wasn't greater, because nominal pay grew really quite strongly, which does, I think, suggest that there are further signs of inflation just becoming more embedded in the UK. I think that the bottom line from that is that the Bank of England will take away from that a somewhat slower sort of path back towards target on inflation, unless they continue to act. So I think there's more data in the UK tomorrow on the household side about necessary retail sales and so on. But really, the theme, not just in the UK, but actually more broadly this week, has been of hard sort of household data not turning over as quickly perhaps as some might have expected, given the extreme weakness in some consumer surveys. So I think that this is something that we're going to have to continue to monitor closely. We're not going to resolve this whole question in the short term. I'll just say, I think the UK view is still sort of, I mean, we are still on the pessimistic side, because we do think that it's important to look through these high-level data and remember that there is a distributional impact here, which is, as it was well understood, inflation does hit hardest for those at the bottom of the income scale, and they will be more constrained, and that is likely to eventually have a macroeconomic impact as well, which will be seen at the higher level. But for the Bank of England, I mean, at this point, there is a big divergence between what the market is pricing in, which is a lot of further action, high probability of 50 basis point moves and so on in the next couple of meetings, well over 100 basis points in over the rest of this year. And the Bank of England's own rhetoric, which is very much, if you just take it at face value, they don't seem to be expecting to have to raise rates by more than another one or two 25 basis point moves. So markets are questioning the Bank of England's credibility at this point.
Yeah, not for the first time, I guess. You make an interesting comment about the retail sales data, because even in the US, we had strong retail sales data. But then, as John mentioned, we have weak retail earnings and weak confidence and stuff. So I think the jury's kind of out there too. Maybe it's delayed effect, but we'll see. So, but you did touch on one other thing, which is the inflation side there. I mean, we also got UK CPI this week. Was it 9%? I mean, how did markets, what are your thoughts there? How did markets take it? Or is that just basically the reason why we have such divergence in the Bank of England?
Well, exactly. I mean, to be honest with you, at this stage, the markets had already adjusted to expect the worst, really. So yeah, 9% is a very, very high number. And in fact, the number that was in all the papers over here was the RPI figure, which were just over 11%, was the highest in 40 years. So you have to go back to 1982 and the oil shocks back then to have seen higher inflation. In actual fact, although that was a little bit higher than the economists' for sort of consensus, which is often tracked, it was a little bit lower than the levels that were actually trading in the inflation market just beforehand. And so actually markets took it with a little bit of relief, believe it or not. And in fact, break-even inflation fell across the board, actually pretty sharply. So, despite these questions about Bank of England's credibility, indicators such as the five-year break even in the UK, it's actually at the low end of its range, back below 4%. So yeah, a lot of things still in the mix, but I would say a lot of uncertainty to come still on inflation. Yeah.
All right, so let's switch to Europe, not immune to inflation on themselves, which has seen some pretty high numbers. But, we have an ECB under Lagarde and oftentimes with Lane that seems to have been reticent to move towards rate hikes, but there's been a shift there. They certainly seem to be steering us towards a July rate hike. Is that just a done deal in your view?
I think it's pretty much done now. We had this period where the doves weren't really saying all that much, and they have been one by one coming out and agreeing, we really need to start getting moving. I think that there's overall a little bit of a feeling at central banks, not just beyond the ECB, in fact, that if they had known 6 months ago or 9 months ago what they now know, they probably would have got to move on a long time ago. So the ECB, I think it's regretting that it's got a little bit behind the curve. I think it has to start moving. July is when everyone seems to be telling us now that, bar a real upset in the data, some significant new information that would allow us to be significantly more economy negative, we will get a rate hike in July. The markets have pretty much, they're already there, and in fact they're starting to entertain the possibility of a 50 basis point move. And in fact, the last I looked at my spreadsheet, we had about 34, 35 basis points in for that July meeting, which I still think is very, very aggressive. I in fact think that it's about as likely that we get 0 as we get 50, just because a lot can happen in the next sort of 10 weeks or whatever it is before we have that meeting. So yeah, I think that the front ends are still too aggressive. No change there. Markets, we now have this very front-loaded path for the bank for the ECB, and then sort of rates plateauing at around 1.4%, which I suppose is around the low end, maybe even the middle of the range that most people have in mind for neutral, but not yet rates going into sort of restrictive territory the end of next year or 2024, which does contrast a little bit with what we see in the US and the UK, where you have a very aggressive path for rate hikes, and then an expectation that then tips us, or at least that there's an elevated risk that tips us into recession, and then you have rates moderating thereafter. We don't see that in Europe, and so I think there is a little bit of a temptation to wonder whether we should. I would say that because there's this sort of, precisely because the ECB has come behind the curve, there's a lot of time for the risks that people have in mind to actually emerge, and then rate hikes into restrictive territory in Europe not actually to materialize. So I would actually say that this sort of midpoint of expectations, where you have rates rise to a certain level and then just stay there, actually makes a certain amount of sense at the moment.
Okay. Yeah, and 10 weeks is an eternity in this market. I mean, in the 10 minutes we've been speaking, equity futures have lost 1%. So, who knows what happens 10 weeks from now. But on the other side of the policy coin for Europe, we've got QE going, and it's still got 6 weeks to run. I mean, you've made the comment that tapering hasn't been fully felt yet. Can you walk through what you mean by that?
Yeah, I mean, it's really very simple. In the short term, what really matters when it comes to QE is the gross purchases. It's not the net purchases. And gross purchases by the ECB haven't really fallen by all that much. In fact, they haven't really fallen at all. And at the same time, on the supply side, things have been actually a little bit quiet, or at least quieter than you would have expected, because obviously the market volatility has been making things difficult for issuers. And I think that there will be payback. There is still funding that's going to have to take place over the remainder of the year. And so I think it's really going to be over the next sort of 6 weeks or so that we really are exposed fully to that. And this isn't a new comment for me, but I think that this will have a real impact. Just to give an idea, our model estimate for the impact of high quality supply, so high quality bond supply, that is AA and above, suggests that maybe 100 billion extra in the short term means a shift up in rates of about 25 basis points. Well, over the next sort of 6-7 months, we'll get 200 plus. So that is going to be a pretty significant shift, and it's one of the key reasons why we have not been turning our rates view in Europe around to be bullish in the face of these sort of this difficulty this difficult market which we're seeing for risk assets, as you have done in the US. So that's still our bias. I think the front end expectations are still pretty aggressive for rate hikes, whereas in the long end, I think that you can still be pretty confident that rates will struggle to fall at the very least.
All right, great. All right, that's all we have time for. Thank you for listening.